Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Welcome, everyone, to another edition of the SHP Retirement Roadmap, brought to you, of course, by SHP Financial. I'm your host, Gregoire, joined by my partner, Matthew Peck, and today we're going in deep into the tax world of financial planning. And I think when you think about planning in general, right, or investments, or having a financial plan, or retiring, everyone's always like, well, I need to save up X amount of dollars. If I have $1 million, I can retire. If I have $3 million, I can retire, or whatever that number is for you. But there's so much more than just a number that comes into retirement planning. And one of the things we're going to get into today is if you're listening and you own an IRA and 401k specifically, either one 403b, you're going to want to listen to some potential tax planning strategies that might be able to save you some money in retirement. We're going to talk about a lot of other areas as well, but before we go any further, Matt, welcome to the show. Everything good?
Oh, everything's great. Certainly looking forward to talking about taxes. I know that, generally people, they shy away from it because no one likes taxes. Yeah. No one likes April 15th, but no, I mean, you have to embrace tax planning because that's the way you win.
I get excited. I actually do. It sounds so corny, but I get excited talking about it because I feel like it's one of those areas that has the most value that you can help folks with in a financial plan.
Yeah.
Like you've Matt said this for years as a CFP, is like, the stock market, we've done a great job here. Our portfolio team led by Matt, we have CFAs. They've done a great job of managing our clients' portfolios, but we can't tell you exactly what the portfolio is going to do year to year because the market changes. It's cyclical. It goes up, it goes down, it goes sideways. There's political events, there's catastrophes, there's health events like COVID, there's wars, things pop up we can't control. But like you say, the tax code is a known. Like right now, we know where if you make X amount of dollars, you're in this bracket. And if you go to the next level, you're at a certain point, you're in that bracket.
Well, and only that too, the idea that, and this isn't always the case, but just the fact that as we've been, throughout our career, a majority of CPAs, or a lot of the CPAs that we work with, are still very, backwards looking. They don't necessarily. They're always focused on ways of saving taxes that particular year, which we are too. Don't get me wrong. But we're also very forward looking in regards to tax planning, which we also talk a lot about on our TV and our shows and whatnot. Yep. But just more that idea that I think combining the planning with the preparing, right, and having CPAs that we can rely on and that the clients can rely on, just allows for us to take advantage of those known knowns, right? Not just not after the fact, not just at April 15th where, have you made an IRA contribution? Like, yeah, that's important, of course, but more about, okay, what needs to get done by year end to make sure it happens in that tax year, because those tax brackets might not be where they are next year, the following year, so forth.
Well, Matt, think about your IRA and 401k is a joint ownership plan between you and the IRS. Let's face it, right? Because if you have $1 million 401k and you cash it in tomorrow, do you keep $1 million?
No.
Pretty sure you don't. You probably owe $400,000 between Massachusetts and the feds, somewhere in that range. Especially if you do it all at once, you're going to put yourself in a high tax bracket. And so imagine you think you have $1 million 401k, but you only own 600 of it.
Well, that's the part too. I mean, I know let's just say on average 20%, right? Let's say your average is 15% for feds and 5% here in Massachusetts. 20%. So at first, 20% doesn't sound like that's a lot. It's like, 20%. Well, I'm keeping 80. But when we're processing withdrawals for people,
Oh my gosh.
I just think in terms of, okay, a client needs $40,000. They're taking out 50. I mean, that's $10,000 in one week or one little click of a button that the client gets 40 and the IRS in Massachusetts gets 10. And that's just $10,000, just boom, just like that, based on a $50,000 withdrawal. It's still just, I know I've been in this business for 20 years. It still blows my mind as to how much you actually need to take out gross in order to net what you need.
Well, I'll take it one step further. And I think if you're listening, pay attention to this part, because this could be frightening. If you have, same thing, you need $40,000, maybe in today's world, and obviously we don't know what bracket you're in, but like Matt said, maybe you need to take out 50 to pay Massachusetts and the feds 10, and then you keep 40. Now, let's say we go by, you don't do any tax planning, you just kind of, all right, I'll just take my minimum distributions when I'm 73 or 74 or 75, whatever the age is when you retire or when you get to that point. And let's just say tax rates have gone up, right? Which they're slated to go up as of 2025, 2026. It's like in Congress that it's going to be higher.
Correct.
And with all the national debt and spending, there's a lot of people that on both parties that think that taxes will be even higher. So let's fast forward a couple of years, right? Now, let's say to get that same 40,000, let's say you need to take out 55,000, right? So that's, your lifestyle hasn't changed. You're still getting the same 40,000. You probably need more than that because of inflation. That extra 5,000 in taxes, it's almost like losing more money in the market every year because taxes went up. And so everyone's so focused on portfolios, dollars and cents, making money, losing money. I'm telling you, if you're looking into retirement or if you're in retirement and you are not looking at taxes as part of your overall plan, you are missing a huge opportunity that could potentially save you thousands of dollars in retirement. And again, this is the average portfolio, the average person that we see that comes into our office. Let's say they have 1 million, 2 million, 3 million. The average person has never had a conversation about proactive tax planning other than just meeting with their CPA every year and filing your basic returns. True tax planning looks, like you said, it looks in the front window of the driver's seat, looking forward into the horizon on what can we do to change things. Doing regular tax filing looks in the rearview mirror of what happened in reacting to that. So I want to say that since we built this company out in 2003 and how we've grown the company is to give our clients and these folks what they deserve, which is an investment plan is important. We need a good, solid, sound investment plan, right? We need an income plan to make sure you have income coming from retirement. We need to look at healthcare strategies, estate planning strategies. And what we're talking about today is world number 3, which is tax planning. And it's one of the most underused, was that even the word? Misunderused? Most underutilized, there you go.
Underutilized, that works.
Strategies of retirement planning. You can tell I'm not an English major. I was a math, financial planning, and went to finance, thankfully. But basically, that's an underutilized strategy. And I think a lot of people are listening are like, what does this even mean? And we're going to get into different worlds of tax planning. The other way you can get educated is to get our guide. We have a white paper that we built out for you that's designed to take you through the 5 worlds of retirement planning, and specifically today, taxes, some of the different tax planning opportunities that might benefit you. To get that guide, it's super simple. Go to shpguides, plural.com. That's shpguides.com, and you can download it right there.
I want to bring up or go back to 2 points that you sort of made there. First is the idea of the 5 worlds, right? Of making sure you have a good investment, income, tax planning, which, as you said, we're going to spend a lot of time today on, healthcare planning and legacy planning. Okay, so let me bring legacy planning back to another point that you made about brackets, about tax brackets, right? Where, okay, here are the brackets today, where they're going to go after 2025 and potentially even further up based on our current fiscal situation. Okay, well, tax brackets are going to go up potentially for your own, personally speaking. But also, too, when it comes to legacy planning and tax planning and why we're so proactive when it comes to IRAs and 403Bs and 401Ks, is because let's just say you pass away relatively prematurely, 70, 75, and now your kids are inheriting all of those IRA dollars. Well, now it's no longer your tax bracket, it's their tax bracket. So let me just play this a little bit forward. So let's just say you had a very, very successful life. You saved about $2 million into your IRAs, and you had 2 kids, and they did very, very well. You took care of college and all that stuff, and now they're CEOs or whatever that may be, and now they're earning $500,000 a year or above. Well, that means their tax bracket is 40, 45, could be as high as 50% when you add in all of the other surcharges. So now that when that IRA as a legacy now goes to the kids, now that IRA money is being taxed at a 50% bracket or potentially a 50% bracket based on the income tax brackets of who's inheriting the money.
100%.
Right? So it's just, because you use a great word, which is jointly owned. Well, you can tell that your IRAs are, sometimes it might be only, you have 80% ownership and the IRS has 20. Well, if they change the brackets, now it might be 75-25. And if it goes to kids and they're highly successful, now it might be a true, jointly owned where it's 50-50.
Yeah.
As the brackets move up, that's how much ownership they have, or the tax man, versus how much ownership you have.
Well, and also, Matt, you look at the brackets in terms of like where they are right now. They're the top federal bracket. It gets close to 50% when you add all the surcharges and the feds and mass and this and that. But the top tax bracket federally right now is 37%. That's the lowest it's been in a long time. Like it's been as high as I think in the 90s at one point back
Correct.
in the 50 years ago or so. And also, if your children inherit the money, and let's say they inherit an IRA, well, back in the day they could just take out a small required minimum distribution, which is maybe 3 or 4%, 5% of the value, and which could it basically made the taxes kind of be drawn out over time instead of being hit all at once. Now they have 10 years to get it out. So if you don't, let's say you forget about it, on year 10, everything comes out.
Yes.
Even if you have no income, if you have a decent sized IRA, that's going to put you probably into the top bracket, even if you have no other income. So there's a whole other strategy that has to be built out for them. And it's not the most tax efficient strategy because that has to come out over 10 years no matter what.
Well, and back to how you mentioned the tax planning and is built on much more solid ground. A lot of what you just mentioned about the fact that IRAs, you can no longer stretch them over your lifetime. Now you can only stretch them over 10 years is because of the Secure Act 2.0. Mm-hmm. Now, there was the Secure Act 1.0 that was passed back in 2019, and then there was another act passed. So I point that out because 2 things. A, it's changing, but then B, it allows for us then to plan on what new acts of Congress come or get passed, which then, as I said, we can take that information with our CPAs, get the team together, and then really learn or adjust and adapt the traditional strategies, which I'm sure we'll get into today, to what the new Congress and the new tax laws are. So it's always this sort of like give and the take about, all right, what are the traditional tax planning strategies, and then how are they now being impacted by the updated congressional acts or updated tax law?
Well, let's say and now obviously there's a lot of bad news we're talking about in terms of taxes, and we're not trying to get everyone upset or depressed about the tax code in their
No,
401ks.
it's fun. This is fun.
Yeah, exactly. Well, here's the good news is there are potentially some tax planning strategies that could benefit you, and that's what we're trying to get into here in terms of like, obviously we've heard terms like tax loss harvesting, Roth conversions, but Roth conversions is one of the areas we should look into, and we do look into for our clients, and that you should really consider. I will, however, say this is one thing you don't want to just take on or do without doing full due diligence on your plan. Because when we're dealing with our clients, and if we're helping you, it's like we mentioned this before, but like all these worlds of planning are commingled and they all affect each other. Meaning we talked about the 5 worlds of our roadmap: income, investments, taxes, healthcare, and estate planning. Well, like how much the income plan that you generate to cover your income in retirement, you need to know the tax ramifications, right? Because if you need $50,000 to cover your bills, right, out of your portfolio, that might be 60 or 70 that have to be taken out first before we pay the taxes, and then get you to 50. So and right now, when you're looking at the tax brackets, I think there's a window of opportunity for the next 2023, 4, 5, maybe the next 3 years that might not exist, right? Meaning if we know taxes are slated to go up in 2025, with our clients, we look at their situation and say, okay, right now, let's say you're in the 12% bracket, federally. And who knows? Everyone's different. Could be 22, could be 24.
Yep.
But we know, okay, 12% changes to 22% at a certain level. And let's say your income right now is at a certain point where you're not filling up that entire bracket. Well, we know 12 is slated to go to 15 in a couple of years, if not higher. So the idea is, let's say we looked at your plan and we realized there's $40,000 of wiggle room that you have between your income now and the top of your current bracket. Well, would it make sense to say, okay, Uncle Sam owns a part of that IRA 401k. If I grow the portfolio, he's just going to own. People think, oh, well, if I do a Roth conversion, I'm going to have less money. That's not true, because if you have $1 million and he owns 20%, he owns $200,000. If you grow it to $2 million, he owns $400,000. So it's not, you're growing Uncle Sam's money as well. So we always say, if we can buy out Uncle Sam on the cheap in a mathematical way that's done properly with due diligence, then we say, okay, let's pay the taxes on 30, 40,000 of your 401k IRA now, where we know it's maybe 12% or whatever that bracket is, before we go into the next bracket. Once you do a Roth conversion, the downside is you pay the taxes now, right? But I'd rather pay Uncle Sam where I know my business partner's buyout is X. So if I buy Uncle Sam out at X, I know once it's in a Roth IRA, that grows tax-free for the rest of my life. Even if, let's say you live 20 years and then you pass away, your kids have 10 more years to pull it out. And they would want to wait probably to the end of the 10th year, because when they cash it out, it's fully tax-free. So they can get that tax-free growth. There's nothing better if you look at the three, we'll go through the tax triangle, but having money in tax-free investments is, to me, the best way. And everyone talks about diversification within a financial plan. Tax diversification. So money's not all pre-tax. All 401k IRA is equally as important.
No, I love the fact that you came back to tax diversification, because I use that not every day, but very, very much in the sense of having people understand that there are different tax buckets to kind of have money allocated in. Some with different goals, I might add as well. You know, where Roth IRA money, since it's tax free, and I'd also add it's not subject to required minimum distributions.
Yep.
So once you do this conversion, the money that's in your Roth money never has to come back out. Obviously, you can if you want to, but there's no involuntary. You're never forced to take money out of it if you don't want to, right? And so again, creating those different buckets, using it for different goals depending on it. I think the other thing I want to make sure, just on a broader level, that people understand that there are, when I talk about tax planning with people too, that taxes are a three-headed monster. Mm-hmm. You have income tax, which is exactly what we're talking about right now. And that's where the Roth conversions and managing RMDs and having plans for IRAs, 401ks, et cetera are, because that's all subject to income tax. Then you have what's called capital gains tax. Now that is if you sell a property, buy a stock, sell a stock, et cetera. So you sell an asset not within an IRA, but that's capital gains tax, short-term gains, long-term gains, so forth and so on. And then finally you have estate or death tax, which is, okay, what happens when you pass away? How much is going to be subject to federal and or state estate or state death tax? So everything we're talking about here on the Roth conversions, we talk about it a lot, because by far, I think the biggest, again, not scientific here, but a majority of our clients have a majority of their assets in IRAs. Yep. So we spend so much time talking about Roth conversions and managing that amount of money, because as you were saying, Derek, we want to buy out Uncle Sam at the best possible time. And then secondly, we want any recovery, because you were saying too about if you grow your asset from $1 million to $2 million. Yeah, we want to do that. We want to let the markets do that, but we want that $1 million to $2 million growth or recovery or whatever you want to call it happening in the Roth money.
Yes.
Because that's tax-free to the individual, and as you were saying, tax-free for 10 years to the kids. Yeah. So tax-free is a great bucket to have money in, let me put it that way.
Think about it in retirement too. If you have different tax buckets, you can kind of play the game a little bit, where I say, okay, I'm only going to take this much out of my IRA to get to this bracket, but then the rest can come out of an after-tax or a tax-free account or a Roth, so I'm not jumping into higher brackets and still meeting my needs from an income standpoint. So as you're listening, I'm sure this is a lot. This is a lot of information, and hopefully it's useful. I know sometimes it's a lot of data, but I think the main thing is we want to make sure, since we've started the company in 2003, and our headquarters are here in Plymouth, that we're bringing good value to the South Shore. We do have offices in Woburn and Hyannis, but this is the area where our home base is. And we want to make sure that like you have the ability to retire and basically live the retirement you've dreamed of, right? And so I think at the end of the day, we have developed a quiz that I think it's worth taking. It's like a retirement readiness quiz is for the best way to put it. And it's a few different questions that you can ask, you can answer in about 5 or 10 minutes. I think it's multiple choice. And if you were nervous, but it does give you a printout of what some areas you might need help in. Because when we talk about tax planning, I'm telling you, the average person that comes to us for the first time doesn't have any of this done. So if you're listening and say, hey, I want to get some planning done, and this sounds great, I need some help here, but I've never done this, I don't want to feel like I don't know what I'm talking about. Trust me, no one else does either when they come into our office. Most people don't, I should say. We want to make sure that you have a plan, and we look at this as one of your planning options. So to take the quiz, super simple. You go to shpquiz.com and type, you can get the answers. It'll print out a report for you at the end. Again, that's shpquiz.com. So flipping over, Matt, I always talk about the tax triangle. I think it's important to know. Mm-hmm. And tax triangle is almost like, well, you have 3 different areas. You have the after tax bucket, right? We call it after tax, meaning like it's money you've already paid taxes on. It's in your like bank account, brokerage account, and most of the gains there are either interest or capital gains, right?
Correct.
Your principal's not taxed, but you're paying interest and capital gains. Think of that as on the left quadrant of a triangle. On the bottom right quadrant, quadrant. It's not a quadrant. It's a triangle. So you know what I mean. On the bottom right third.
There it is.
Yep. You have the pre-tax bucket, and that's all your IRAs, 401ks. That has never been taxed. You get the benefit. Uncle Sam said, "Hey, when you put money in, we'll give you a deduction, but for the rest of your life, all the growth, withdrawals, everything is fully taxable. That's never been taxed. Every dollar that comes out is taxed, and that's taxed at whatever your bracket is at that point." Going to the top third of the triangle, you have the tax-free bucket. Now, that's ultimately where, in a perfect world, you'd have everything, because that's the best. Tax-free is if you need to take out $50,000 out of your portfolio, you just take out $50,000.
Yeah, I was going to say that because we were talking about the withdrawals earlier, and it's just anytime we send money from a Roth, it's like, no, there's no withholding taxes. No, what you ask for is exactly what you get. That's it.
Exactly. So think of the bottom 2/3 of a triangle, right? You have, ideally, you want the after tax and the pre-tax money, you want those flowing up to the top third to tax-free as much as possible, right? And every plan's different, but to get it to the after tax to tax-free, there's things like Roth contributions, right? Making contributions to a Roth. If you're working, sometimes you can make 401k Roth contributions, right? And each one, the 401k does not have income limits. The Roth IRA contributions do, but sometimes people aren't even contributing to Roth. If you can put $14,000 a year for 10 years, that's another $140 that you can move from a after tax to a never tax bucket.
Well, that's the thing too. Whether it's Roth contributions or Roth 401ks, just on the 401k front, make sure you know what your employer is sponsoring and what's available there. And then for your Roth contributions, obviously, again, there's income limits on the Roth contributions, just separate from the 401k. There's a lot here. I apologize for all the jargon, but it's more so just make sure you're taking advantage of it.
Yep. So that's on one side, we're trying to flow as much of the after-tax monies up to tax-free.
Right.
On the other side, the other right third of the triangle, we're trying to get, how do we get money from the pre-tax to the tax-free? That's through conversions. So the idea is through a well-thought-out plan over time, it's not done all at once, unfortunately, but through a well-thought-out plan, we try to get as much as we can within reason from the bottom 2 buckets to the bottom 2 sides of the triangle to the top, which is tax-free. And everyone's different on how much we can get to there. But if you have even a portion of your retirement in a few years, whereas right now you have nothing, you have to start somewhere.
Right. I mean, it's 2 things. First, I just want to point out, because we get a lot of questions on contributions, on going from your post-tax into your tax-free account. There are income limits and there are contribution limits. Conversions are unlimited. Mm-hmm. So you can do $1 million, $2 million all at once to do a conversion.
Don't.
However, exactly. However, so it's unlimited in that amount, but it is not exactly the most efficient way to do it, because it's like, how much taxes do you want to pay? And as Derek, as you were saying, the idea of, okay, doing it over time, methodically, and appropriately. And so it's like, if you implement it properly, if you take the right steps and measure how much you can do each individual year, and take each year individually too, right? I mean, every situation changes. Maybe you sold a property, maybe there was an inheritance. Obviously, your income situation is going to change year by year. But if you slowly but surely diversify, tax diversify, slowly but surely move from tax-free to post-tax, from pre-tax to tax-free, you're creating that tax diversification. You're adding more money to those buckets that we said about the different tax buckets. And then any of that recovery, like we were saying earlier, happens within the tax-free bucket.
Yeah.
So, and just to bring into on the broader level, that's why investment planning and tax planning and income planning all work together. So I just love that idea, but I just really wanted to clarify contributions versus conversions. Contributions are limited, conversions unlimited, except for you just have to be tax efficient with them.
Yeah, you'd be surprised, Matt. We have some folks that come into our office, and it's neat because a lot of times they'll come into our office for the first time, and they'll have like $2 million, and it'll be all in 401ks, IRAs, and then there's like $40,000 in a bank. So it's almost, there's very little diversification. Yes. And this is common. The neat part about it is I've seeing clients go through the last 3, 4, 5 years, and I'm using short term. We've been doing this for over 20 years, but seeing them now have like $300,000-$400,000 in a Roth, right? Some money in post-tax. We're building some tax diversification in their plan, so when they get to retirement, it's not just every dollar is taxable and we have no other flexibility. And that's what I love seeing. So I think the major point of the show is obviously I would recommend having a tax analysis done on your situation. We're not CPAs. We work with a lot of CPAs, but I think this is just really forward-looking planning. Especially if you have IRAs and 401ks. There's other strategies we haven't even talked about, like tax loss harvesting, other tax codes. I think it's 702, if I remember right. But
there's like 77T, the Massachusetts state tax.
Yeah, there's so many other things we haven't even got into.
Right.
But the main thing is, I think a tax analysis. If you're listening, you say, I want to know how much taxes am I going to pay on my IRA and 401k, and are there ways to alleviate it, right? Sometimes the savings can be really significant over your lifetime. So I would recommend when you come into a visit here, if you come into Plymouth office, first we're just going to get some basic information from you, and then we'll take that information and sit down with our team and share the strategies that are best suited for your specific plan, your specific situation. There's no cost to do so, obviously. We just want to make sure that folks are taking it as seriously as we are. If you want to come in and take advantage of that analysis, the number to do so, super easy, call 508-276-4109. Again, that's 508-276-4109. Or you can also book a visit and get a ton of information online at shpfinancial.com. Matt, thanks for the information. For everyone listening, I hope that was informative around tax planning. We have a lot more to get into in the future around healthcare planning, estate planning, and more. And we'll probably have special guests along the way to help bring the most value we can. So thank you so much for listening. Have a great rest of your week, weekend, and whatever you have planned ahead. And we look forward to talking to you next week right here on the Retirement Roadmap, brought to you by SHP Financial.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.